Well, hello, and welcome back to Principles of Accounting 2. I'm your host, Dr. B, and we're going to talk about cost, volume, profit analysis, also known as break-even. For those of you who own your own business, or you're looking to start your own business, this is going to be a very important discussion for you, because you need to know how much to sell your stuff for. How do you set your sales price? Well, the way you set your sales price is we're going to cover all of our operating costs. Because in business, we don't want to lose money. How do you not lose money? You got to find the point of break even. Break even is where your sales equal your expenses. Break even is where your sales price equals the cost of production. Break even means that we are not making a profit, but we're also not losing money. That's break even, right? That's what it means to break even. Well, I broke even. That means I didn't win, I didn't lose either. I broke even. So I'm going to talk about the different methods to computing break even, and I'll also talk about why we do it, right? So in business, everything is around human behavior. The same can be said with cost. Cost is behavioral. Behavioral. I don't know if I'm saying that right. Cost is based on behavior. What do I mean? No, supply and demand is. Demand goes up, supply goes down, supply goes up, demand goes down. That's behavioral. The sales price changes based off of changes in consumer demand. The sales price changes based off of other behavioral changes. Okay, in other words, the customer don't like that no more, so we get rid of it. The customer wants more something else, we bring that in. Behavioral. Along the lines of behavior, we try to figure out cost, volume, profit, meaning break even. One of the things we got to figure out is how many units do I need to sell to break even? How much income do I need to break even? What happens if one of my machines break or my people quit? What happens to my labor cost? What do I need to break even if that happens? What if my sales price goes up? What if I discount my product? How many more do I need to sell to break even? Or what if my sales price goes up? How many do I need to sell to break even? Right? What if my product changes? How many do I need to sell to break even? Or one of my favorite ones is if I want to generate a profit of $20,000, how many do I need to sell to make that profit? We call it target income. These are all great questions. And to figure out the answer to those great behavioral questions is to figure out the break even. Now, we remember that the cost of a unit is the fixed cost plus the variable cost. Fixed cost plus variable cost is the total cost, right? Fixed cost plus the variable cost is the total cost. Fixed costs, as you recall, are costs that do not change regardless of the level of output. They remain constant. We call those fixed costs. Example of fixed costs would be supervisor salary, rent, depreciation, costs that do not change. regardless of how many units I'm making, it's the same expense every single month, right? Do not change. Fixed cost. It's the same amount for 12 consecutive months. Fixed cost. Variable costs are costs that do change with the level of output. Examples of variable costs would be direct materials and direct labor, and to some degree overhead. Those are variable costs. They change with the level of output. And so the total cost is fixed cost plus variable cost. In this example, our variable costs are $20 per unit, fixed cost $32,000. $32,000 plus $20 per unit is my total cost. And we can see the relationship of fixed and variable costs based off of the levels of production, seen in the chart below, on the bottom. We can also see that the more units I produce over time, the allocation fixed cost per unit also goes down. So on the top, we're looking at fixed costs as being static, right? We can also see, though, if I were to allocate that $32,000 to the number of units being produced, I can find what we call the fixed cost per unit. And the fixed cost per unit and the variable cost remains the same, direct materials, direct labor, a little bit of factory overhead. Those remain the same per unit. My fixed cost per unit goes down with the level of output. That means my total cost per unit also goes down with the level of output. This kind of shows us the relationship, right? So at the top, fixed cost, straight equal. At the bottom, it's per unit. So top, total fixed cost. The bottom, fixed cost per unit. We do the same thing with variable costs. We know the variable cost will increase per unit. The variable cost will increase per unit in relationship to fixed cost. But we also know that the fixed cost per unit will decrease with the total number of units, and the variable cost remains the same. Now we also have this thing called, I'm sorry, Makia, go ahead.
You said the fixed cost per unit decrease. You said it decreases?
Yeah, so let me break that down for you a little bit further. So the total fixed costs remain the same, right? Total fixed costs remain the same. So $32,000 for the year in fixed costs. That remains the same, okay, regardless of the level of production. I can allocate the fixed cost to a per unit basis. So if I take that 32,000 and I divide that by the number of units I'm producing, I can find what we call the fixed cost per unit. And the more units I produce, the lower my total fixed cost per unit is. Does that make sense?
Yes. What about the volume and activity for fixed costs?
Of activity. Yeah. So the greater the volume, meaning the number of units being produced, the greater the volume, the lower my fixed cost per unit is. So the more units I produce, the lower my fixed cost per unit is. But my fixed cost total remains the same regardless of how many I'm making. So the top chart represents the total for the year. The bottom chart represents me applying that total for the year to the number of units being produced. You got it. Exactly right. So it just kind of shows us a relationship based off of the volume, if you will. Yeah. Cool. You're very welcome. Now this cost I want to introduce to you, and I think we talked about it briefly maybe a week or so ago, 2 weeks ago, I don't remember. It's called mixed cost. Mixed cost is fixed plus variable. Fixed plus variable cost, we call that a mixed cost. Now here's an example. I'm going to give you a real life example that a lot of businesses have to deal with. Even people have to deal with this to some degree, in your personal lives. So I can think of let's say you're on a cell phone plan. Okay, you got a cell phone and you're on a plan. And the plan is 3 gigabytes of data and unlimited talk and text for, we'll say, $50. Okay, so $50 a month will get you unlimited talk and data and 3 gigabytes of data, unlimited talk and text. All right, that's $50 a month. Now, what happens after you hit the 3 gigs of data? You get charged more, right? So the fixed cost is 3 gigabytes of data plus unlimited talk and text. That's the fixed cost part. But once you go over the 3 gigs, it's like you hit the next tier, right? And now you got to pay more for that month. That's from the personal example. From the professional example, let's say you have a business and you have a copier machine that you rent or lease. I'm sorry, that you lease. You lease a copier machine for a couple of years, whatever. And you have to pay a certain amount every year to lease the copy. And so that's the fixed amount, right? Once you go over 10,000 pages of printing per year, once you go over that 10,000 pages, you then have to pay 1 penny per page. The fixed amount is the amount you pay every year. The variable cost is that penny per page. So fixed plus variable. That gives you a mixed cost. Make sense? Fixed plus variable gives you mixed. Cool. Thank you. Now this one kind of goes along. This one matches actually better with the cell phone example I gave you earlier, stepwise cost. Or I got, we'll say 700 megabytes, and then it goes up $20 once I hit that amount, and then it goes up another $20 when I hit 1,300 megabytes, etc. That's what we call a stepwise cost. It's kind of like you use a certain amount, you go over, then you have to use that additional. And if you go over that, then it goes up again. It's called a stepwise cost, and that's what that represents. Ranges, if you will. And then another type of cost is called a curvilinear cost. This increases, but is non-linear. That's what I call curvilinear. It's kind of like very variable, very variable. Don't worry too much about the curvilinear. I'm not gonna. We can also estimate cost using other statistical methods. There are three statistical methods that we can use in accounting to estimate fixed or variable costs. One is called a scatter diagram. Another one is called the high-low method. And the third one is called regression or linear regression. Don't worry, this is not a stats class. So I'm not going to be testing you guys on this, but it's important that we understand the statistical approaches to estimating cost. So we have fixed and variable costs. The fixed cost is represented by that straight line on the bottom, $17,000. What's my fixed cost? My estimated, my variable costs are represented by those little green dots. January, February, March, April, May, June, July, August, September, October, November, December. We can see how it goes across the line, right? Those little green dots represent each month. And I can average out all of my months using a scatter diagram where I draw a cost behavioral line. That's what we call a scatter diagram. It's where each of those green dots represents a different month for variable cost. I can use that darker orange line to kind of like get a gauge of where my cost behaviors are. Now, if there's an outlier, it's like, oh, March was like ridiculously high. Call that an outlier. And so the line would actually shift. Another method is called the high-low method. This one is actually used pretty frequently in accounting. And we identify the relationships between the number of units produced and the total cost, the high amounts and the low amounts throughout the year. So looking at this data from January through December, I can see that my high month was August. How do I know that? Well, in August, I produced 52,500 units. Wait, no, I'm sorry, it's not August, it's November. November was my highest month. November, I produced 67,500 units at a total cost of $31,000. Right? That's my highest, right? Yeah. My lowest in this data set is June, right? 18,500? Yeah. June's my lowest amount, 18,500. Total cost, number of units, 17,500. So the first thing we do is we identify the high and the low. And we can compute the variable cost per unit and the total fixed cost based on the high and low amounts. And so the way we do that is we have first we identify the high and the low, which we just did. And we identify the change in activity. So we take the high minus the low. High minus low gives me change in activity. I can also identify the change in cost. High minus low divided by high minus low. Change in cost, change in units. So change in cost divided by the change in units will give me, this example, 25 cents, which is the change in equivalent unit. I can also identify the change in the total cost, right? So I take the fixed cost amount, or I can find my fixed cost amount. And the way I do that is I take the variable cost per unit that I got from the first step times the number of units sold. So variable cost per unit times the number of units sold. So total cost. So I take my total cost minus the variable cost per unit sold to get my fixed cost. And the last statistical method is regression analysis. Ugh. No, we ain't going to do all that, let me tell you. But the regression shows us the total fixed cost and the total variable cost per unit in a relationship method. That's as far as I'm going to go into that. But yeah, because regression, I mean, that's a whole stats class in itself. We're not going to go that route. But we can see the relationship between the high-low method and the regression method. We're not going to do the regression method. I'm not going to do that to you guys. I mean, I don't like stats. I'm not a stats person. I'm just not. Yeah, I don't do that stuff. Okay. Now, when we're talking about break even, we find break even based off of our what we call a contribution margin. The contribution margin is essentially like saying, this is my profit margin. Contribution margin, similar to profit margin. And the way it works is we take our sales price per unit minus the total variable cost per unit. That gets me what's called the contribution margin per unit. Once I find my contribution margin per unit, I can also find the contribution margin ratio. So sales price, $100, minus variable cost, 70. Gives me contribution margin per unit of 30. Sales minus variable cost gets me contribution margin per unit. I can also find the contribution margin ratio by taking the contribution margin per unit divided by the sales price. So $30 divided by $100 is 30%. That's a pretty good ratio, actually. 30%. But basically what that means is 30% of all of my sales is going to be profit. And that helps me to also find the point of break even. Your sales, once it equals your total cost, that's the point of break even. At the point of break even, the company doesn't make a profit, but they also don't have a loss. This could be expressed in the number of units that we need to sell or have sold, or sales dollars. There are three primary methods for calculating break-even. One's using the break-even formula, very straightforward. The second is using the contribution margin income statement, and the third is using the cost volume profit chart. The formula for break-even in terms of units and sales dollars is very straightforward. We take the total fixed cost divided by the contribution margin per unit. Fixed cost divided by contribution margin per unit. Remember, how do you find contribution margin per unit? It's the sales price minus the variable cost per unit. So fixed cost divided by sales price minus variable cost to find contribution margin per unit will get you your break-even point in units. So 24,000 fixed cost divided by $30 contribution margin per unit tells me I need to sell 800 units per month to break even. How do we find the break-even point in sales dollars? We take fixed cost divided by the contribution margin ratio. Remember, the contribution margin ratio is found by taking the contribution margin per unit divided by the sales price. In this case, 30%. So 24,000 fixed cost divided by 30% gets me to $80,000 of sales per month in order to break even. So now we know how to do break even in terms of units and break even in terms of sales dollars. We could also find break even by using what's called the contribution margin income statement method. This is also very straightforward. The way it works is we take our sales minus variable costs to find contribution margin. minus fixed costs to find our income. So, looking at a standard income statement, we have sales minus cost of goods sold equals gross profit minus selling administrative expenses equals net income. So you might be saying, well, okay, so how do we find the contribution margin? Sales minus variable cost. How do we find variable cost? It's the number of units sold times the variable cost per unit. We know the variable cost per unit in this example is $70. So sales minus variable cost equals contribution margin. Minus fixed cost equals net income. When net income equals 0, we have found the point of break even. We can also find break even using the cost volume profit chart. The cost volume profit chart shows us the break-even point. It's where your revenue, sales, equals your cost. In this example, graphically, 80,000 sales dollars, 800 units is the point of break-even. We're neither making a profit nor are we making a loss. It's a point of break-even, for profit equals loss. We can also find changes in estimates. What this shows us is what happens when something changes. Well, we can estimate those changes. For example, if the sale price changes, that means my variable cost per unit changes. That means my total fixed cost will change. So based off of those changes, I can find the new break-even point. And that's what this shows us here. When we talk about break-even, we also want to find what's called the margin of safety. I like this term because it's pretty straightforward. Margin of safety is, and I'm going to put this very generally, it's how safe I feel in business, right? It's, I have enough revenue to feel good about being able to pay all my bills. That's the margin of safety. That's really what it is. The formula for margin of safety is sales minus break-even sales divided by expected sales. So expected sales minus break-even sales divided by expected sales gets me the margin of safety. For example, 20%. You always want to plan to sell more than breaking even, right? That's why we call it margin of safety. We can also compute the income from sales and costs. Sales minus variable cost equals contribution margin minus fixed costs equals net income. And you can also do the reverse to find how much you should be selling. This one I like, target income. A target income is like saying, this is how much profit I want to make at the end of the year. Target income. I plan to have this kind of income at the end of the month. Target income. That's how much you want. Target income. We take our fixed cost plus our target income, how much you want to make, divided by the contribution margin ratio. Fixed cost plus target income divided by contribution margin ratio gives you your dollar sales of target income. fixed cost plus target income divided by contribution margin ratio. In other words, my target income of $12,000 plus my fixed cost divided by ratio means I should be selling $120,000 worth of stuff in order to generate a target income of $12,000. You can also find how many units you need to sell to get your $12,000 target income. Fixed cost plus target income divided by the contribution margin per unit to find the number of units you need to sell to generate $12,000 in income. We can also find the sales for the target income by working backward. Target income, fixed cost. So you find the contribution margin is fixed cost plus target income, contribution margin minus your plus your variable cost will equal your sales. It's basically working backward, right? You can work backwards and forwards. Sometimes your sales price will change. And when your sales price changes, you need to revise your costs. Or maybe your fixed costs went up. Your fixed costs changed. So now you have to change your break-even point. And you can do that just by looking at what was changed, right? So we take the revised fixed cost divided by the revised contribution margin ratio to find the new break-even point in sales dollars. Now, a lot of companies sell more than one product, believe it or not. So we use what's called a sales mix to average the point of break-even. Really, the best way to do it is to find the contribution margin per unit, different types of units that you're selling, to find the sales. So, the word composite means more than one unit, right? More than one type of unit. And so the formula for that is fixed cost divided by the contribution margin per composite unit, or the average of units. We apply this thing called a sales mix ratio to determine the most common units that will be sold. In other words, the most popular units. In this example, we have a hair salon. And this hair salon, they have basic haircuts, ultra haircuts, and budget haircuts. And the most common one is the basic haircut. And so this is the data we have: sales price, variable cost, contribution margin. Sales price minus variable cost equals contribution margin, and we can also identify this sales price. To find sales mix and break-even point, sales price minus the sales mix ratio, times the sales mix ratio will give us a sales price per unit, and then we take the total selling price divided by the composite unit. Sales price minus variable cost will get you your contribution margin per composite unit. Don't worry so much about the composite stuff. We usually always do things individually, but it's important that we talk about it. So the break-even point in composite units, we take the fixed cost divided by the contribution margin per composite unit. It's very, very similar to any individual unit, right? Fixed cost divided by $64 composite unit means I need to do 3,000 total haircuts to break even. So if I do 3,000 total haircuts of each type of unit, I can get the total number of haircuts I need to make for the year by taking the sales mix times the composite units. This is a income statement that is broken out based on the point of break even, based off of each type of unit being sold. Number of units times the sales price, you get total contribution margin minus fixed costs equals an income. Costs can be classified as either being variable or fixed. They can be linear within a relevant range, every available unit to be sold, and sales mix is constant. Those are the key assumptions with cost, volume, profit analysis. This one's fun, operating leverage. Operating leverage tells us as a business what my ability to generate additional sales and what the effect will be on my profits. That's what the degree of operating leverage tells me as a business owner. And to find that, we take the total contribution margin divided by the pre-tax income amount from the income statement. That'll give me my degree of operating leverage. Anything above 1 is considered to be good. Here we have an example, 36,000 contribution margin divided by sales tax, pre-tax income, 12,000. Gives me a degree operating leverage of 3. If there's a change in the sales price by 10%, it would show a change in income of 30% because of the degree of operating leverage. Yeah, we'll probably never ever do least squares regression, but I just wanted to show you what that looks like in Excel. So, but yeah, this is not a stats class, but you can graph it. You know, graphing is nice. The last part I need you to know about are these things called what was I just going to tell you about? Absorption costing. Oh, yeah, I wanted to tell you a little bit more about the contribution margin. With respect to the contribution margin, you know, understanding the sales minus variable cost, that's like the basis of everything with cost, volume, profit analysis. So once you find the contribution margin, I mean, everything else will fall into place. Remember, it's all about the steps. Yeah. That, my friends, is the end of our discussion on cost, volume, profit analysis. Any questions on break even? Break even. All good? Y'all still awake? I haven't been talking on mute the whole time, right? All right, cool. Okay.
No, I'm still here.
All right, good. That's good. I'm happy. You're all still there. You're all still awake. That's a good thing. All right.
Yeah,
Okay.
I'm here.
Okay. Lucille, thank you so much. I appreciate you. Appreciate you being here. Okay. Real quick, I want to point where we are in the classroom because time is flying by. We are already in week 3. So week 3. Week 3, here's what you got going on this week. It's a very, very busy week. And it's not just what's shown, okay? So you have the Chapter 20 quiz, which is on the discussion we had on process costing. It's the same as the other stuff, 5 questions, you got 2 attempts. the highest attempt is accepted in the grade book. Just like the homework assignment that we just had, that you'll have on cost, volume, profit analysis. 5 questions, there's 2 attempts, highest attempt is taken in the grade book. Now, here's the kicker, all right, the moment you've all been waiting for. Now, when we started this journey 3 weeks ago, I had said that there's a midterm exam and a final exam. The midterm exam is here, believe it or not. The midterm exam covers chapters, where we started, 17, 18, 19, 20, and 21. The midterm exam covers chapters 17, 18, 19, 20, 21. What does that mean for you? Well, in addition to the chapter 20 quiz and the chapter 21 homework assignment, we also have the midterm exam. The midterm exam, oh, this one's a kicker, okay? It's worth 20% of your total grade. Oh, I know, 20%. Oh my God, Dr. B, what are you doing to me? I can't believe it. Yeah, 20%, I know. Let me show you what it looks like. I'm going to do it in the student view because I don't want you to see the answers. Okay, so in the student view, I'm going to come down. Oh. Okay, I'm in the student view. I'm going to come down to week 4. Midterm exam. The midterm exam covers chapters 17, 18, 19, 20, and 21. It is worth a total of 20 points. That is 20% your final grade. Taking a look at the exam. Okay, here's how the breakdown is. It's 1 point per question. It covers chapters 17, 18, 19, 20, and 21. It goes in that order. So if you think about it, if there's 20 questions, and there's 17, 18, 19, 20, 21, 5 chapters. 5 chapters, 20 questions. Oh, that, if I had to guess, you could figure out how many questions per chapter, right? On average, there are about 4 questions per chapter, roughly. Okay? Well, 3 questions, 4 questions. So it goes in order. So the first 3 questions, even based off of reading them, I can tell you comes from chapter 17. Oh, here's a question on job order. Where do you think that comes from? Here's they go in order. Okay? So as long as you are carefully reading, and you'll see most of the questions here. I'm not seeing a whole lot of math questions. Well, here's 1, 2. There might be 3 math questions. 3 math questions, 4 math questions. 4 math questions. The rest of them are a mix of true, false, multiple choice. As long as you know the definitions, you'll be fine. So the midterm exam is also due on Sunday night. So you got 3 things going on this week, y'all. 3. You have chapter 20 quiz, chapter 21 homework, and the midterm exam. All of these things are due by April 3rd. Now, I might push the midterm exam back just by like 2 days. So that way you have just a little bit more time, okay? So probably by the 5th, the midterm exam will be due. Now, please try to get everything done by this Sunday. 20 quiz, 21 homework, midterm exam by this Sunday night. I'll push the midterm exam back by 2 days, but don't wait till the last day, please. I need you to make sure everything's done before then. Does that make sense? Y'all good with that?
Yes.
Okay, great.
Yeah.
Great. Take your time with the midterm exam. It's open book, open note. It's all right there. All you got to do is just, my recommendation for success in the midterm is go back through the 17, 18, 19, 20, and 21 assignments. Kind of review the questions again. You can even try the exercises. Those are helpful. Definitely the PowerPoints. Yes, for sure. Even go back and watch some of the videos if you want. But I promise, you'll do very well. Just take your time with it. Remember, you can open it up. You can save your answers. You can come back to it. You don't have to do it all in one sitting. But there's no reason why you couldn't ace this exam. So, having said that, any other comments, questions, or concerns? Okay. Okay. With that, my friends, please make sure you get everything done. Chapter 20 quiz, 21 homework, midterm exam. If you have any comments, questions, or concerns, you can email me, call me, set up office hours, whatever it takes. I'm here for you 100% of the time. And as always, I want you to please stay safe. Wash your hands. Do the right things, and I'll see you all again, same time, same channel, next week. Thank you all so much for your time today. I appreciate all of you. Have a great night. Bye-bye.